What if I told you there's an opportunity to grow your portfolio by investing some of your money in individual companies? And you can easily read a company's financial reports just by watching some of my YouTube videos. Even if you're a complete beginner or someone who doesn't like complicated maths or even finance or anything to do with accounting, you've come to the right place, because I will break it down for you. I will make it so simple for you. You probably wonder why you didn't do this in the first place. Look, you don't need to whip out your wallet. Just keep it with you. I'm not trying to sell you any course. I am simply sharing my knowledge with you and help you to evaluate companies better in future. So for this first episode, we will cover the income statement and some of the basic things around it. This is a very basic level, but I'm hoping that it will really inspire you to start looking at financial statements as an investor. So what is an income statement? An income statement is a financial report that gives us information about how much money a company earned and spent during a specific time period. These periods can be monthly, quarterly, or yearly. Publicly traded companies usually release their financial statements on a quarterly and yearly basis. And the income statement shows the money that the company earned from its sales and other sources, as well as the money that they use to operate the business. By analyzing the income statement, we can check if a company is making more money than they are spending. As an investor, it helps you to assess the company's financial performance and make informed decisions by reading the income statement. So we've built a lemonade business just in time for the summer. It turns out that there's a real thirst for lemonade this year, and people are just queuing up for it. Now, let's talk about the financial stuff using the lemonade business as an example. We are going to use the lemonade business to go through the income statement and explain how it works. First up, we're going to talk about the revenue. Revenue is basically the money that we make from selling our delicious lemonade. But wait, there's a bit more to it. It is not just the cash that we get from customers. It also takes into account things like discounts, promotional deals, returns from unhappy customers or confused customers, and even value-added taxes from the sale of our lemonade. We recognize revenue when we sell our lemonade to our customers. So when we hand a cup of refreshing lemonade and they give us the money, that's when we count it as revenue. By the way, revenue goes by so many fancy names. You might hear people call it top line because, well, it's right at the top of our financial report, or the headline because it's like an attention-grabbing news that shows how much we are making as a company. Some people call it turnover, net sales, or just plain income. Okay, so drum roll. For our lemonade business, we made £25,000 in sales. Can you believe that? That's the amount of money that we brought in by selling our fantastic lemonade to our happy customers. Next up is the cost of goods sold. The cost of goods sold is the direct cost of making our lemonade and providing our services. It is the ingredients and the supplies we need to make our lemonade and deliver it to our customers. Our cost of goods also have fancy names as well. Some people call it cost of sales because it's the cost directly related to the sales that we make. Some also call it direct cost, cost of services, or cost of revenue to describe the same concept or the same thing. Okay, so before we make our lemonade, we will need a mixer, some lemons, some sugar, some cups, ice, maybe water, straws, you name it. Just think about it. The cost of all of these ingredients and supplies and any other expenses related to the wages of our lemonade making workers make up the cost of goods. Now, let's talk about numbers. For our lemonade business, the cost of goods sold amounted to £10,000. Yeah. That is the amount that we spent on all the ingredients and materials needed to make our lemonade. And it is the biggest expense that you will see in an income statement because, well, we are competing with other businesses. So we need to get the best quality ingredients for our customers. Now, here's the exciting part. By subtracting the cost of goods sold from our revenue, we get to know how much profit we make or made from our lemonade business. We are basically taking away the cost of making that lemonade from the money that we earn from selling it. And the difference is what we call gross profit. Just like our previous financial terms, gross profit also goes by many other names as well. Some people call it trading profit, whilst others refer to it as gross income, gross earnings, or gross margin. Let's play with some numbers right now. Okay, so we had a total revenue of about £25,000 from selling our lemonade, and the cost of goods sold amounted to £10,000. When we subtract the cost of goods sold from our revenue, our gross profit will be roughly around £15,000. That's the amount left over after accounting for the direct cost of creating and selling our lemonade. So gross profit is very important because it shows us how much money we are making from our lemonade without any other expenses attached to it as well. So it's the first part of our profit that we've made. It gives us an idea as well of how well we are managing our production costs and also pricing our lemonade. So as we continue perfecting our lemonade recipe and finding our ways to cut costs, we can then try to increase our sales and be more efficient in the way we manage it. Running a business isn't just about squeezing some lemons and making that delicious drink. We've got to consider all other expenses as well. And these expenses cover the cost of running our business during the trading period. So they are the costs for operating our business. You might hear people refer to it as research and development. And research and development is all about experimenting with new lemonade flavors that we want to share with our customers. Marketing, for example, is when we want to promote our lemonade to the rest of the world, or even sales and marketing when we want to combine them all together and max it all out. Also, let's not forget selling, general and administration for all those miscellaneous expenses that keep our business running. So let's focus on the numbers a bit more. The operating expense for our lemonade business was £5,000. That's the money that we've spent on things like advertising, marketing, salaries for our lemonade promoters, rent of our lemonade stand or spot, and any other expenses that is to do with our running of our lemonade business. Operating expenses are a big deal, and by keeping an eye on these expenses, we can control our spending much better. So the next part is depreciation and amortization. So in our lemonade business, we have some important assets that help us run our business. We've got our trusty lemonade delivery van, our handy storage facility, and some special assets like goodwill, patents, trademarks, and customer mailing lists. These assets are what we call long-lived assets. They are things that are expected to provide value to our business for more than a year. We recently bought our delivery van. They are brand spanking new. When the sun just hits it, it just looks amazing on the rims. So it's looking really amazing, right? It's looking really good. It's reliable. It helps us deliver our lemonade to our customers all around town and even the facilities. But here's the big deal, right? The lemonade van will lose their value over time as they age and wear out. So depreciation expense is a way to spread our cost of the van over the number of years we expect it to serve us. It helps us to account for the wear and tear on the van as we deliver our lemons to our warehouse and lemonade to our customers. These assets don't have a physical presence, so they are not physical, but they hold significant value for our business. Amortization expense allows us to allocate the cost of these intangible assets over the expected useful life. It's like gradually recognizing the value of these assets as they contribute to our business over time. And that's what amortization is like. So accounting for depreciation and amortization expense helps us to reflect the true state of our business. And it also gives us a clear picture of our overall profitability. By taking out the cost of running our business, including the wear and tear on our assets, we arrive at what we call operating profit. Operating profit tells us how well our business is performing at its core operations. Just like our previous financial terms, operating profit goes by a few other names as well. Some people call it operating results, others refer to it as operating income, and some even call it operating earnings. So let's crunch the numbers because this is what we are waiting for, right? So how much are we making right now? Our gross profit from all those lemonade sales amounted to £15,000. But remember, we also had operating expenses of £5,000 and depreciation amortization now of £500. So we subtract all of these costs from our gross profit and our operating profit becomes £9,500. Operating profit is important because it shows us how well we are doing without any influence of other expenses that might fluctuate. As our lemonade is doing well and we are doing amazing, there are things that we need to do to expand our business, right? And this is where borrowing comes in. Interest expense is the amount of money that we have to pay on the debt that we are taking on for borrowing. Just like our previous financial terms, interest expense also has some other names to it as well. Some people refer to it as interest-bearing debt, or borrowing, to keep it very simple, or interest loans. So let's talk about some numbers here. Since we borrowed money from the bank, we have an interest expense of £1,000 on our loan. Interest expense is a non-operating expense because it is not directly related to the core running of our business. So it's not part of the core operations of our business. This is why it's called a non-operating expense. It's important to keep track of interest expense separately because it helps us to understand the true cost of borrowing and how it impacts our overall financial performance. By subtracting interest expense from our operating profit, we get what's called the profit before tax. Profit before tax is the profit we've made before we have to consider those taxes from the government, the taxes that the government loves to collect from us. Just like our previous financial terms, profit before tax goes by other few names as well. Some people call it pre-tax profit, others refer to it as income before taxes or earnings before taxes. After considering all the costs of running our lemonade business, we received £9,500, but also had an interest expense of £1,000. So when we take away the interest expense from our operating profit, we end up with £8,500. Profit before tax is useful because it shows us the financial performance of our lemonade business without any tax obligations that we got to pay to the taxman. We are going to talk about taxes. Taxes, I hate taxes, right? You all hate taxes. Tax is the amount of money that our company sets aside to fulfill its tax obligations to the government. And just like our previous financial terms, others call it income tax expense or tax provisions. In the world of public trading companies, they often have an effective tax rate of around 19 to 21%. So let's go ahead and use 20% tax rate as a reasonable estimate to set aside for the government. Let's do some maths here. We have our profit before tax. After considering all other expenses and interest amounted to £8,500. Applying a 20% tax rate, we set aside £1,700 for the taxman. When we take away the tax expense from our profit before tax, we get profit after tax, which is £6,800. This is the amount of profit that we have left after paying our tax to the government. Profit after tax is significant because it tells us the actual earnings that we can keep and reinvest in our lemonade business or reward ourselves as business owners, so as equities as well. Just like our previous financial terms, profit after tax goes by many names. Some people call it net income, others refer to it as net profit, bottom line, earnings after tax, or net earnings. So that's pretty much it. If you really enjoyed this video, make sure you like, subscribe, hit that bell notification so that you do not miss any updates. It's really nice and warm outside in UK, so I'm just gonna go out, chill, and make some lemonade.